Now, as humans, we are naturally poor investors and we're often tripped up by our own minds, and behavioral biases lead to irrational investment decisions and the market anomalies like crashes and bubbles that we see. So, if we want to become better investors, we need to understand these biases and how they influence our decision making. Now, I'm going to go through a list of 7 of the main ones that I think are the most important. But I did do a full list of 14 of these for 80/20 investor members. So you can look at that full list and see the examples as well as the ways in which you can try and mitigate the biases from impacting your investment decisions if you take out a free trial of 80/20 investors. One of the main ones is loss aversion. So this is where investors tend to feel the pain of losses more strongly than the pleasure of equivalent gains. So this fear of loss can lead to them making impulsive decisions, especially when they see their investments decline in value. So an example of this can be where an investor might hold on to a losing stock or fund far longer than they should because they are afraid of realizing that loss, even if selling the stock and reinvesting the proceeds in a more promising opportunity would be the rational choice. Now, ironically, we are actually seeing a real-world example of this play out right now in US tech stocks. So following the release of the Chinese AI model DeepSeek, Nvidia's share price plummeted 18% in a single day due to concerns that a new lower-cost AI model could disrupt the US dominance in the AI sector, potentially reducing the demand for and the profitability of Nvidia's expensive chips. Now, those chips are used to deliver AI to the world. So loss aversion is driving much of the behavior we've seen in that slump, because in reality, no one really knows yet what's going to happen with DeepSeek. They aren't even able to verify the claims of the creators or quantify its future impact on AI. So perhaps DeepSeek's advancements could be positive for AI stocks because we're driving down the cost of AI and increasing consumer adoption, which maybe could be good news for companies exploiting the technology. Who knows? But investors are focusing on the falls and the 18% loss right now and reacting to the news rather than the 200% gain they've made since ChatGPT made its debut in November 2022. So you can see that aversion to loss is dominating their thoughts rather than the money that they've already made. So the strategy to try and avoid loss aversion is perhaps to use things like stop loss orders. So they are automatic alerts if a stock falls beyond a certain value. So it means you can stop watching and worrying about your investments. And so they will fire off if the value falls a certain amount, and that can therefore limit your potential losses and hopefully prevent emotional decision making during market downturns. The other, perhaps more important thing to do is focus on long-term perspectives rather than focusing on short-term market fluctuations. So to put it another way, if you are worried about markets falling, then the best way to mitigate the impact is to actually increase your investment time frame and review your portfolio a bit more regularly. So moving on to the next bias, confirmation bias. Now, this one is prevalent in the investment world, and this is where you seek out information that confirms your existing beliefs while ignoring contradictory evidence. So you imagine if there's an investor who believes in a particular tech company and it's going to be the next big thing, then as an example, they might eagerly read articles about the company's innovative products and growing market share, but conveniently ignore reports about its mounting losses or any competitive threats. So any concerns about the company's valuation or management team that are brought up, they might just be dismissed by the investor as negativity or short seller manipulation. Furthermore, they might primarily follow analysts who are optimistic about the company's prospects while ignoring those who express caution. Now, this confirmation bias can lead to overinvestment in that particular company, in the example I've just given, blinding them to the warning signs and the potential losses that could happen if the company fails to live up to the hype. Now, confirmation bias means that we also tend to more easily recall things that reaffirm our beliefs over those things that don't. Now, if you want to see how we easily fall victim to confirmation bias, there's a really good YouTube video that's called Can You Solve This? We'll put a link to it in the notes of this video. Go and have a watch. And there's a very simple question that the interviewer asked everybody in relation to numbers. And they are all trying to guess what his rule is. And it is a really good example of confirmation bias. And I would suggest that most people who watch it will probably fall foul of the same confirmation bias that everybody in the video does. So do go and watch it, because it's a very good example of how you can fall foul of confirmation bias. But the thing is, confirmation bias is prevalent in mainstream media as well, if you look out for it. So you often see analysts and experts that are wheeled out onto TV programs or quoted in the press that tend to have a similar theme or viewpoint. It might be about AI, it might be about the path of interest rates in the UK. So that means try and find the counter view of what you're looking at. Try and disprove any theory you have. That's the scientific nature, to try and disprove any hypothesis you have, not trying to confirm what you're thinking. Try and disprove it and find the holes in that. That is the central point of any investment research I carry out on 80/20 Investor. And the other thing, which is just a bit of fun, is try and spot the confirmation bias in the things that you read and see in the media regarding things like investments. So if you can do that, and you can then see it in other people, you'll see it in yourself, and hopefully you'll be able to challenge your own assumptions. But also do try and acknowledge the limitations of your own knowledge and focus on continuous learning, because you don't know everything. The next bias is anchoring bias. Now, this is the tendency to over-rely on the first piece of information that you receive. That's called the anchor, even if it's irrelevant. So this initial anchor can significantly influence subsequent thoughts and decisions, even when presented with conflicting or more accurate information. So if you want an example of this, and you're thinking about investing, it can mean anchoring on the price at which you bought a fund or share, or it could be the previous valuation of a fund or portfolio the last time that you checked it. So that number then takes an increased importance in your mind and will possibly influence your decisions on whether you sell or keep an investment. Now, anecdotally, I think that anchoring is one of the biggest biases that people struggle with, particularly people who have communicated with me via 80/20 Investor. And that's because they focus on the price of the fund when they bought it and the profit and loss that they have. Now, long-term subscribers will know that I never reference the price at which I buy a fund. Otherwise, just like everyone else, I would inevitably allow my emotions to creep in. Instead, what I do is look at the other investment opportunities out there and compare them to the things that I hold at that moment in time. So that means I don't focus on whether I sell a fund at a loss and move the money into a new investment. I focus on what is the best investment, I think, at that period of time with the information that I have. Now, the next bias I want to talk about is hindsight bias. And this is where you believe past events were predictable. So an investor might claim that they knew something all along when it actually happens, when they look back with the benefit of hindsight. Now, a good example is Brexit. So there may be people who claim that they saw it coming. It was predictable. In reality, it wasn't. It caught most people by surprise. But those people who say they knew all along might now go and make investment choices based on their new perceived ability to predict things like geopolitical events. Another example might be if you go back to early 2020, so when we had the COVID-19 pandemic, stock markets were tumbling, economies were imploding, and somebody may have put a small investment into the stock market against that prevailing fear. Now, following unprecedented monetary and fiscal stimulus across the globe, stock markets rebounded aggressively, which would have quickly seen the investor's small equity investment rally significantly. Now, hindsight bias would lead the investor perhaps to state that it was obvious that stocks would experience this V-shaped recovery and would exceed pre-pandemic levels within a year. They would be boring everyone they ever meet at maybe barbecues or parties to say that they are an absolute genius and they made a killing. Now, this could lead to overconfidence, which is another bias, which impairs their future investment decisions. Because in reality, back in 2020, nobody knew the depth of the pandemic equity slump. They didn't know if it was going to keep going. They didn't know what was going to happen in terms of lockdowns, or whether entire economies that had ground to a halt would actually recover. And when, we didn't even know, for example, when there was going to be a vaccine developed. Now, obviously, if we go back and we look at things with the benefit of hindsight, it might seem obvious that things turned out the way they did. But in reality, that wasn't obvious. So how can you mitigate this kind of bias? Well, I'm fortunate because I produce an investment newsletter each week that I send out to subscribers. I also review my portfolio every month, and I have to justify any changes that I make. So this means that in the last decade I've been doing that. There's 500 newsletters and 50 portfolio reviews. And as such, that means there's a complete body of work that records every thought I've had and the decisions I've made, as well as the information I had at the time. Now, obviously, anyone watching this isn't going to do that. But what I would suggest is that when you make predictions or you make investment decisions, then do note down why you did that. What were the thought processes that you had, and what sort of information did you have at the time? Then hopefully in the future, it will help you make rational decisions and recognize the unpredictability of events. So I'm going to move on now to herding bias. So it's essentially when you go with the crowd, even if it goes against your own judgment. And it's probably better known as FOMO, so the fear of missing out. So you could have somebody, for example, who is an investor that jumps on meme stocks and cryptocurrency without really understanding the risks because everyone else is apparently doing it. So that raises the interesting question whether momentum investing is just built upon the idea of herding bias. Is it just herding bias in action? Well, it's not. They are fundamentally different things. So herding bias is primarily driven by social factors like that fear of missing out or the assumption that the crowd knows something you don't. So that leads to the irrational behavior of chasing bubbles or maybe panic selling. But in contrast, momentum investing is driven by data and trends. It uses objective data and analysis to identify assets with strong upward price trends based on the rationale that these trends tend to persist for a period of time. So momentum investing can be implemented with a systematic, rule-based approach that incorporates risk management techniques. That's very different to just buying something because somebody down the pub told you that it was a good idea, which is what herding is. So how do you limit the impact of herding bias? Well, stick to an investment strategy. So a plan and understand the investments that you hold and ask yourself the question, are you only thinking about the investment because of what other people are saying or doing? The next bias I've touched upon slightly is overconfidence bias, and that's overestimating your own abilities. So an investor might, with some success trading individual stocks, for example, become overconfident, and they might take riskier bets using leverage on other stocks and ignore the warning signs leading to significant losses. Now, interestingly, Warren Buffett, who is one of the most successful investors of all time, has emphasized the importance of knowing your circle of competence. So the circle of competence refers to areas where you have genuine knowledge and expertise. And Warren Buffett said, know your circle of competence and stick within it. The size of that circle is not very important. Knowing its boundaries, however, is vital. So do make sure you know what your circle of competence is. I know what mine is. I'm not a trader in individual stocks. I'm very good at building portfolios out of funds like unit trusts, ETFs, and investment trusts. I'm not a crypto expert, which is why I don't talk about investing in different types of cryptocurrency. So do make sure that you stick to your circle of competence. I've done that. 80-20 Investor is a beautiful example of that. And I've been incredibly successful with my own 50k portfolio, teaching other people how they can do it too. Final bias is endowment bias. This is where you value something simply because you own it. So that could be an old car, for example. But in investing, you could hold on to shares that you inherited in a struggling company due to the sentimental value of them, despite the fact that the shares are slumping and the company is struggling. So to mitigate endowment bias, you need to evaluate your investments objectively, consider opportunity costs, so other things out there that might be better than what you're holding right now, and separate emotions from financial decisions. So one tip I would say, in order to stop endowment bias impacting my investment decisions, I look at anything I hold and say, if I was looking at this today with new money, would I invest in that particular fund, for example? And if the answer is yes, then it's worth holding. If it's no, then it's worth considering whether to sell that particular fund. In summary, it's not about being a perfectly rational investor, immune to all of these biases. We are human after all, and they are ingrained in us. What matters is actually recognizing when these biases might be influencing our decisions and taking steps to mitigate their impact. By understanding how our minds work and developing a sound investment process and seeking objective advice when we need it, we can improve our decision-making process and hopefully increase our chances of investment success.